A very good day to you all, and welcome to the 6th episode of Market Replay. If you're tuning for the first time, I'm your host, Koketso Diklakanyani, founder and chief technical analyst at ACE Forex Academy. Just to give you a brief understanding of the aims of these videos that I post, and the aim of these videos is just to highlight the different opportunities that were presented to us in the markets over a particular day, right? So I will then be looking at a day's worth of price data in the form of candlesticks, right? And then I will be highlighting the different trading opportunities that were presented to us over that particular day for a specific currency pair. For this episode, we will be looking at the United States dollar against the Swiss franc, and this will be for the 17th of July, which was our past Friday. Okay, not to waste any more time, let's get into it. We're first going to start off by marking out the trend, right? So our day started out with bulls. However, their power didn't last too long and the bears kicked in, right? Then trend changed to the upside, and we had our series of higher lows, higher highs, higher lows, higher highs, higher lows, and higher highs. Then price changed to the downside and gave us our lower highs and lower lows. Okay, the bears kept pushing and they continued to push, right? Bears kept pushing the price down. Okay, and then we had a brief period of consolidation, right? So what I'll be doing is highlighting these different periods of consolidation, and then I will be revisiting them later after we've had the general view of the markets. All right. So following this period of consolidation, the bulls then kicked in, pushed price higher. Okay, and then they gave us another period of consolidation, right? Where they ultimately lost the battle and the bears kicked in and pushed price to the downside. Okay, after the bears then broke out and pushed price to the downside, we had another period of consolidation formed right over here. Okay, and price was continuously pushed to the downside, right, with the formation of our low lows and our lower highs, right? Low high, low low, low high, low low. Okay, keep following the trend, right? At this moment, the bulls were then briefly back in power, but that didn't last long because the bears then kicked them back down, right? And they managed to drive price to the downside. Okay, and then we had a brief moment of consolidation. Okay, then price was then pushed to the downside again, right? Followed by another brief moment of consolidation. Right? Then price was further pushed to the downside. Lower high, low low. A brief moment of consolidation. Then price was pushed to the downside, right? Had another brief period of consolidation. Then price continue to go down. Okay, up until our day's close, right? So this is the general view of the United States dollar against the Swiss franc. As we can see, the bears were in power for this day because prices just fell from 94589 right down to 93863 to around there, right, approximately that amount. So this was quite a bearish day, right, for the dollar, right, as the Swiss franc gained strength against the dollar, right, pushing it down. Now let's revisit these consolidation zones that I've marked, and let's try and understand the different trading opportunities that were presented to us, right? We'll begin with this first one. Just to give you more information, I'm a day trader, so you'll see me take most of my trades on the 15-minute chart, right? And that's because I don't hold any particular positions open overnight, right? We are all different as traders, and we know that what varies the most is the amount of screen time you have, right? So I spend quite a lot of my time in front of my charts as I'm doing this for a living, right? So starting off with this consolidation zone over here, if you can carry this through from the previous episodes, what I like to do is start on my left, right? And by starting on my left, what do I get to do? I get to understand history, right? And that's very powerful because that means that I can avoid, or I can foresee possible price actions playing out in the future, right? And in this particular zone, or in this particular point, I then had a swing to the downside, right? And this gave me a area of support, or your area of demand. Okay, if you are looking at it in terms of supply and demand, your area of support will be your area of demand, and your area of resistance will be your area of supply, right? So what this zone over here, my support zone, alerted me to was the fact that we had buyers parked in this position, right? Remember, as a trader, your main objective is to sell at a very expensive price and to buy at a very cheap price, right? So in this particular moment, this zone that I have marked over here indicated my cheap price. So I knew that buyers were parked in this particular zone, right? And that's from forecasting from the history, right? So this zone then acted as my leading indicator into the future, right? So with that understanding, then pulled out my Fibonacci tool, forecasted this move down, and as we can see with the close of this bullish candle, I then had a pullback or a retracement that exceeded 50%, right? And that's what I'm interested in. I don't take shallow pullbacks, and when I say shallow pullbacks, I'm referring to pullbacks that are below 50%, right? I'm looking for 50% and above, okay? And with that understanding further, what do we then see? Price then indicates that if we have a close below this low over here that I've marked out, right, we can then go for a sell position, okay? Using our modified Fibonacci tool, we would have taken a sell on the close of that candle, and using a very conservative stop loss, right, what we can then see is that this trade gave us a good 1:2 risk reward return in this particular trade, right? So we were risking, or we were going to make, or we have made, right, twice as much as what we were risking when we were taking this particular position, right? So as you can see, our minimum risk reward of 1:1 sits well above our zone, right? And 1:2 just sits above our zone, right? And as we can see, with the power of being able to forecast your history, bears tried to enter that, but there were too many sellers parked in this particular zone, and they ended up pushing price back to the upside, right? That's why it's always important to forecast your history so that you can understand or foresee the possibilities that might happen in the future. And we were saved by being able to forecast into the future with this particular trade, right? But this was a good trade. We had a good 1:2 risk reward ratio return on this trade, right? And as we strive for a minimum of 1:1, what I like to highlight is that remember that the bigger your risk reward ratio, the lower the probability of it working out, right? That's what we have seen with the experience that we have in the markets at Ace Forex Academy, right? So that's why we always strive for a minimum of 1:1, where you will then have a partial close of your position and you will let the remainder run. Okay, so we can move on to the next one, which is this one over here. Let's go back and revisit our lower time frame, right? So let's then continue. We start on our left. Okay, remember your objective is to understand the history. Thereafter, what you want to do, you want to forecast the history, right? So what do we have the formation of here? We have the formation of a swing high. Swing high gave us our area of resistance or our area of supply, right? Remember, sellers are people who are selling off their CFDs, right? And if you had a store, you are owning a store, you would definitely want to sell your product off at a markup, right? You don't want to sell it for a cheaper price. You want to sell it for the most expensive price, and that's what our resistance zone represents over here, right? With that information, let's pull out our Fibonacci tool and let's forecast. Now what we can see with our Fibonacci tool is that this bearish candle over here gave us the close below 50%, right? And that's what we strive for. Okay, it's this close below 50%. Okay, and what did that then indicate to us? It indicated to us that we needed a close above that high before we could take this particular position, right? Let's pull out our Fibonacci tool and understand our profit targets, right? With a focus to the upside, what we can then see with this particular trade is that our minimum risk reward ratio of 1:1 sits on our resistance zone. So this was still a valid trade to take, right? Because our profit target forecast was not beyond our zone. It was still in a feasible area where price could still reach, and even if price were to turn around, we would have still made a 1:1 risk reward return from it, right? So we would have taken this trade with a stop loss just below this low over here, all right? And as you can see, price then pushed to the upside and hit our 100% level, which marks our 1:1 risk reward return on this particular trade, right? So this is how you would have then taken the buy position with this particular setup, right? And you would have walked away with a good 1:1 risk reward return on this trade. Okay, let's move on to the next one, and that's this zone over here. Okay, let's have a look. All right, notice nothing changes. My strategy is the same. Start on your left. What does my left give me? Swing low. What does the swing low give me? Gives me my area of support, right? So this is my area of support, or you can call it your area of demand, all right? That tells you that there's a possibility that buyers are parked within this position, and if price enters this zone and the amount of buyers far exceed, or the buyers are much stronger than the sellers in the market, price will then be pushed back up to the upside. So you want to make sure that you have considered that before prices reach the zone and you have taken the necessary steps, right? When we pull out our Fibonacci tool and focus this move to the downside, we see that this bullish candle over here far exceeded our 50% retracement, right? But upon further inspection, what we then see with this particular pair is the classic setup of your fake out, right? Remember that this yellow over here marks out our resistance drawn on the highest time frame, okay? And price then tried to break above it, but then they closed back below it. All right, and that resembled our classic fake out. So you would have taken a sell position when they closed back under your resistance, okay, which is on that candle over there, and you'd have used a stop loss just above that high over there. And looking at this particular trade, what we can then see is that our forecast for our minimum, which is 1:1, sits well above our zone, right? And our forecast for our max 1:2 sits well above our zone. Okay, so this trade was a very beautiful trade. As you can see, it gave us more than 1:2 risk reward return. Okay, we're probably looking at 1:5, 1:6 reward return, and that's because of this fake out position that we have. So that's how we took this particular sell of the United States dollar against the Swiss franc, right? So it's swing low, fake out, and then price continued to fall and pushed to the downside. Okay, it would have been a good runner if you let it run, but I love taking my profits. Okay, you've got to know when to walk away. There's always opportunity in the market, right? Don't be greedy, but of course let your winners run, right? Let's move on to the next one, which is this particular trade. Let's have a look. Right, what do we have? Formation of a swing low, right? What does a swing low allow you to forecast? It allows you to forecast your area of support, like what we have over here. Okay, let's forecast that, or our area of demand. So we know that there are buyers parked in this position, so be careful when selling, right? Because sellers we may start taking profits here and we weaken the side of the sellers, and then buyers then kick in and then push price back to the upside, right? That understanding, let's pull out of Fibonacci. Let's forecast. So what we see with this particular trade is that we don't have a break above our 50% retracement, right? So this trade is of no interest to us because it doesn't meet our trading rules, right? And our rules state that we wait for a minimum of a 50% retracement, right? So we would have not taken this particular trade because it's very shallow. It's a shallow pullback, and shallow pullbacks don't give you enough clearance or distance from your areas of supply and demand, and that then results in a poor risk reward ratio, and that's not what we are aiming for, right? So no trade on this particular setup, right? Even though price did push to the downside. Okay, let's move to the next one. Same standard operating procedure. Start on your left, have a swing low. Okay, mark the swing low out. Let's understand what happened. Okay, there we go. Swing low allows us to forecast the area of supply over here, our area of support, okay, which then represents our area of demand, right? So we know that buyers are parked here. So when I'm selling, I should be careful because price could push down and from there push back to the upside. Okay, let's pull out our Fibonacci tool, and what do we see? Okay, we have this bullish candle close above our 50% level, right? Let's close that. We have a repeat over here, same instance. Okay, we have the formation of a fake out, right? Price broke above our resistance that was drawn in the highest time frame, and then it closed back below, right? When price did that, what do we then do? We then take the sell position and they close, and we put our stop loss just above that high. Okay, and studying our possible profit targets, what we can then see, our minimum, which is 1:1, sits well above our zone, right? Our 1:2 sits well above our zone. Okay, so with a sell in this position, we would have walked away with a good 1:2 to around 1:2.5 risk reward return on this particular trade, right? Because both of our profit targets go well above our area of demand over here, right, where the buyers were parked. Okay, and that's how we would have simply taken this trade. All right, waited for a deep pullback, and when it came, waited for the fake out, and then we sold to the downside. All right, so that's how we would have taken this particular trade. Okay, let's move on to the next area, which is this one over here. Okay, start on your left. Okay, when you start on your left, you have to understand your history and then forecast it into the future, right? So what we have here is an area of support over here, which represents our area of demand, right? And with that information in mind, let's pull out our Fibonacci tool, focus that move to the downside. Okay, and what we can see is that this bullish candle over here closed well above our 50% retracement level, right? And that then gave us the signal to wait for a close below this low before we could sell, right? And when we took this sell, okay, with that candle closing below our low, we can then see our possible take profit forecasts, right? First was the 100%, then was the 200%, right? As you can see, price smashed through our 1:1 risk reward ratio, and it further went to the downside where it hit 1:2, right? So we walked away with a 1:2 risk reward ratio return on this particular trade, right? And as you can see, the importance of forecasting, right? Price then entered our zone and had some minor pullback. Again, they bounced back because we knew buyers were parked in this particular area. All right, and that's how we would have simply taken this particular trade, right? Let's move on to the next consolidation region, which is the last one, this particular region over here, right? And let's have a look. Right, what you do, start on your left. Okay, have a swing low, right? And a swing low gives you your support, right? Area of support, which then gives you area of demand. So you automatically know that buyers are parked within this particular region, right? And pulling out our Fibonacci, we can then see that this bullish candle gave us a close above our 50% retracement, right? So it meets our criteria for a sell, right? However, we needed a confirmation close past that low. Okay, but when you look at it, that confirmation sits right in our area of demand, or it sits right in our supply zone. Okay, so we wouldn't have taken this particular trade, right? Because we know that there's a chance that price might turn to the upside. So you wouldn't want to sell where the probability of turnaround is much higher. Okay, so we wouldn't have taken this particular trade. Let's have an overall look, and that's it for the United States dollar against the Swiss franc, right? As we can see, had a very bearish day on Friday, right? The dollar was pretty weak on Friday against the Swiss franc, and there were some good selling opportunities presented to us during these consolidation zones that I have marked out all right over there. Okay, guys, that will be it for today's episode. If you liked the video, please do. If you liked the video and you found it very insightful and you find it very eye-opening, please do like the video. If you want me to look at a particular currency pair on the next episode, please do leave a comment in the comment section of the video, right? And if you are subscribing or have already subscribed, please do hit the bell notification icon so that you can be notified the next time I upload the next episode, right? Thank you for tuning into this episode, guys. Cheers.